Okay, good evening. This is Professor Mayer, and this is our fifth chat session. And in this fifth chat session, we're talking specifically about the planning and control of liabilities as well as shareholder equity. Keep in mind that as we talk through this, is one of the primary focuses that we talk through relates to the internal control structure that is the responsibility of the controller. And I think it's very interesting and important that we understand that one of the key areas that the controller is actually responsible for relates specifically to the internal control structure. So we basically have been walking through the balance sheet. We've talked about the accounts receivable, we've talked about cash, we've talked about inventory. Now we're going to focus specifically about liabilities as well as shareholder equity. And we're doing this from the perspective of, again, initially starting from an understanding of internal controls. You've seen this introduction before. Internal controls is the whole system, financial and non-financial, established by management to carry out the business of the enterprise in an orderly and efficient manner. We're adhering to policies, we're safeguarding assets, and we are, as far as possible, ensuring the completeness and accuracy of records. So you notice here that we talk about internal controls, but we're also talking about it from the perspective of financial as well as non-financial areas. Non-financial areas, you kind of think about this, and we've talked about this from the COSO model of internal controls. COSO model of internal controls is a top-down approach. This top-down approach is something that emanates from senior management as well as the board of directors, and it is a philosophy and an ethical environment that essentially is created by these individuals. One of the key components related to non-financial controls is essentially hiring the right people for the organization. Hiring the right people for the organization implies that we're not hiring crooks, but we're hiring people that actually have an ethical background and that have the skill set and are willing and able to actually complete the jobs that they've actually been assigned to. So you notice that as we're talking through this, is what should come to mind is human resources. So human resources is a control structure embedded within an organization, and this control structure is extremely important as we consider internal controls being a whole system or a holistic approach related to ethics and internal controls within the organization. But what we're talking about is tonight related to liabilities. So we want to talk about liabilities, current as well as long-term, how we actually control for these liabilities. Now keep in mind that, and again, I always try to think of things from the perspective of an auditor. From an auditor's perspective, what the auditor is interested in is making sure that we're actually reporting the liabilities that actually are the part of the organization. So when we think about the controls over liabilities, we need to make sure that we understand what these liabilities are. We need to make sure that we understand that some of these liabilities can in fact be a liability, but in fact not be something that's reported on the balance sheet. And we'll talk about some of these things as we go forward, but we're all interested in understanding how all of these mechanisms actually affect the internal control structure within the organization. So when we talk about liabilities, what we're looking for is the recording and disclosure of liabilities. This includes indenture or credit agreements. And clearly what we want to make sure of is that we're also recording these contingent liabilities that in fact are items that are not necessarily related to journal entries, but related to events and circumstances where the liability is probable that we're going to have to pay, and we have a reasonable estimation of the amount that we actually owe. So what we need to do is we need to maintain acceptable debt to credit equity balances. And when we start thinking about this, what we're going to talk primarily related to is making sure that we're actually managing the debt and equity in such a way that is most appropriate for the organization. Clearly want to maintain that access to funds is on acceptable terms. We also want to make sure that what we see here is controls to ensure liabilities are for legitimate business liabilities and not restrictive and burdensome. We also need to understand that many liabilities, whether these are bonds or mortgages or whatever, may in fact have restrictions, and these restrictions may apply to the organization, or covenants may apply to the organization as we are in fact managing the business. So in the background of these liabilities, there are restrictions or covenants that we need to maintain. Maybe we need to maintain a certain cash flow, maybe we need to maintain a certain debt to equity ratio. There's probably going to be a number of things that we need to maintain so that we are not in violation of these covenant agreements related to this long-term debt. So we need to understand the whole structure related to debt as we are moving forward. So the first thing we want to talk about is current liabilities. Current liabilities are those items that are expected to be satisfied within the next period, generally speaking within the next 12 months. Now, one of the interesting things is when we start talking about long-term debt is when we have long-term debt is we're going to separate out the portion that's actually due within the next period. So on the balance sheet, in the equity or the liability section, you're going to see a line that basically says the current portion of the long-term debt. And the current portion of the long-term debt is the amount that's owed on long-term debt, but it's the amount that's owed within the next 12 months. So we need to understand how much that is. And why do we need to understand this? Well, we clearly need to understand this from a budgeting perspective, because as we are looking through the budget, we're interested in making sure that we actually have the money available to pay for this debt. So there's going to be liquidity issues. Liquidity essentially is, do we actually have the cash? Now, we talked about cash several weeks ago when we were talking about accounts receivable. And one of the things that became very interesting and a very important takeaway when we started talking about accounts receivable, generally speaking, in a business that has a high amount of accounts receivable, is the cash lags sales. So you're not going to, even in the best of circumstances, not going to get your money from your sales until a couple of weeks, or in some cases a month or two after the actual sale. Which means, and again, we went through this calculation, that the amount of cash flow, generally speaking, is going to be less than our actual sales. We need to pay our bills. Clearly, we need to pay our bills, payroll, but, and we're not necessarily talking about payroll in this discussion, but payroll has got to be paid. You absolutely need to pay your employees. But beyond this, we have to pay our vendors, and we have these other responsibilities, other liabilities that we're concerned with. Again, we have long-term debt. There's going to be a current portion to that long-term debt. And as we talk about long-term debt in terms of various issues, is if we have a bond that's basically an interest-only bond, and then the principal is paid at the end of the bond, well, we need to make sure that we actually have the cash at the end of the term to pay off the bond. So liquidity, very important. Liquidity, when we start talking about this, make sure we understand, is making sure that we have cash, the appropriate amount of cash at the time that we actually need cash. The current liability management decisions generally come about from other decisions. And what we mean by this is the primary current liability is going to be inventory purchases, or purchases that essentially relate to the current services and goods and services that essentially support the business. Is we need to consider this from the perspective of how we're actually going to pay these liabilities. This is, in fact, requires decisions from management. So, as an example, many times there's a policy that is in place where we're going to pay 30 days end of month, or 60 days end of month, or if in fact you become very aggressive maybe 90 days end of month. But what this basically says is that whenever the bill comes in, you're certainly going to process it. So you process it in terms of going through the account payable cycle. You approve this for payment. This then gets pushed over to the disbursement department. But just because it's pushed over to the disbursement department doesn't mean it's going to get paid as soon as it gets pushed over there. What we're saying here is that the policy is going to be something like 30 days end of month. So 30 days end of month essentially means, let's say we get the bill on March 5th. We approve for payment sometime during March. Well, we count 30 days, that becomes April 5th, and then we pay that at end of month, which is April 30th. So an organization will probably have one, maybe two, maybe three, and again, depending upon the organization, but only a couple of check runs every month. And again, a very good policy is that if you set this up where you are managing your debt, and you're managing your debt in terms of it's going to be end of month, 30 days, end of month, what that means is all the accumulated debt during March is not going to be paid until April 30th. And then the April bills are going to be paid May 30th. But this is very good, because what that means is that the organization knows how much cash they need as of April 30th to pay their bills that have been accumulated and approved for payment during the month of March. Setting up a very specific policy related to the payments becomes extremely important as we are managing our cash flow for the organization. Now, accrued expenses, a little bit different, and we've talked about accrued expenses as an example related to payroll. Most times payroll does not end exactly at the end of the month, and there's going to be several days when in fact we are accumulating the expense, but instead of creating a check run, we're essentially setting this up as salaries payable. And then at the end of the week, when the check is actually cut, is that salary payable essentially is eliminated. So what we're saying here is that the accounts payable, the payments related to accounts payable, become the critical issue related to actually generating a strategy for managing cash. Some of the accrual expenses, they got to be paid. So you have some wiggle room related to accounts payable. You don't necessarily have unlimited, because you got to get, these people need paid. They need paid in such a way that they understand that there is an expectation that we're going to get paid. And if they understand that the expectation is they're going to get paid 30 days end of month, well, that's a good thing. That means that they understand exactly what this is, and they can deal with that accordingly. Accounts payable is the place where we are managing our cash primarily. We don't necessarily want to play the game related to our vendors excessively, because these people need to get paid. They're depending upon you so that they can pay their bills. But at the same time, there should be no expectation where that as soon as the bill comes in, it's going to get paid. There are management decisions that you need to make as a controller in terms of when these items get paid. Those decisions are really going to be based upon our cash flow and liquidity issues, and essentially how we actually develop the policy related to payments. Current liabilities, current ratio, quick ratio. Current ratio is current assets divided by current liabilities. Very good ratio in terms of understanding where we are. That number in and of itself may or may not be of significant value, but what it does is we can actually compare ourselves month to month, determine if in fact we are getting better or getting worse. Quick ratio essentially is the scenario whereby we essentially need to pay our customers.
The quick ratio is also known as the asset test ratio. This ratio gives us the ability to consider how we're going to be able to pay debt in what we would consider a crisis situation. In this ratio, the numerator is cash plus marketable securities plus accounts receivable, and the denominator is our current liabilities.
Net working capital essentially is current assets minus current liabilities. All these things are essentially focusing on the ability to pay our debt, to pay our current debt. Current debt to net worth essentially is, net worth is our equity. So what we're really doing there is we're separating our debt from current versus long-term and comparing that to the equity. Current debt to inventory, all these ratios essentially is focusing on our ability to pay our bills. Now, payable turnover as well as days it takes to pay essentially is looking at how often we're actually paying our bills and how long it actually takes us to pay our bills in the complete cycle. It becomes very important because, again, we're not necessarily interested in cutting this to several days. We're actually interested in extending this to a reasonable period so that we can manage our days payable in this complete process. Cash cycle really is looking at the complete cash cycle. Again, we've talked about the cash cycle from the perspective of sales. Now we're looking at the cash cycle in terms of paying our liabilities. And the question becomes is, if we're not getting enough from sales, not getting enough cash from sales to pay our liabilities, we have a problem. And the issue becomes is how are we actually going to manage that problem? Now, interesting scenario here. This is actually coming from a from the disclosures of a company, and the disclosures of the company essentially is saying that they have an agreement with a third party to provide an account payable tracking system which facilitates participating suppliers' ability to finance payment obligations from the company with designated third-party financial institutions. Participating suppliers may, at their own sole discretion, may offer to finance one or more payment obligations to the company prior to their scheduled due dates at a discount to participating financial institutions. The company's goal in entering this arrangement is to capture all supply chain savings in the form of pricing, payment terms, and vendor funding. So the issue here is just kind of think about the strategy. So the strategy is, well, you know what? Maybe if we can pay our bills early, we're going to get a discount. And managing this essentially helps facilitate the process. And then the other issue is, well, maybe we can use a third party in terms of sort of smoothing out the rough edges related to the payment cycle with a number of our vendors, and as opposed to paying everything up front, we're actually letting this third party to finance these obligations, and maybe through the financing of the obligation we're actually able to spread out the payments in such a way that we can manage the process much better than we can working on our own. So what we're looking at here, which is actually kind of interesting, is we are engaging the vendors in such a way that we all understand everybody's going to get paid, but we want to make sure that we're getting paid in such a way that it actually benefits us as well as they're getting their money. And if they're not getting the money, they're getting the money plus some, basically they are providing a loan to the organization. So as of January 30th, 2015, January 31st, 2014, $1 billion and $753 million, respectively, of companies' outstanding payment obligations have been placed in the accounts payable tracking system. Participating suppliers have financed $724 million and $443 million, respectively, of those payment obligations to participating financial institutions. So by using a third party in this arrangement, what we're able to do is we're able to smooth out the edges in terms of this payment cycle, recognizing the fact that everybody's going to get paid, and taking advantage of early payments when they are appropriate, as well as taking advantage of extending the payments for a small interest rate that's essentially accommodated by this third-party bank, and vendors get paid, and the bank essentially acting as an intermediary, they're taking out some sort of percentage in terms of holding the loan, but doing that, we're actually able to manage the process. Now let's look at long-term debt. We've talked about long-term debt from the perspective that it's due in more than 12 months. So we have acknowledged the fact that in our long-term debt is that we do have the current portion related to long-term debt, but we also need to understand that there is a long-term portion. Well, time flies faster than what we think it does, and this debt needs to be paid. The question becomes is how is that actually going to get paid? So as an example, if it's a mortgage where the payments is basically an annuity where we're making principal and interest, is we're looking at a very specific cash flow, and that cash flow is pretty easy to manage. But if in fact it is a bond where we're essentially paying the interest on the bond, but there is a balloon payment at the end where we're paying back the principal in one lump sum, then the issue becomes is how we're actually managing this from the perspective of making sure that we have the money available or making the arrangements to refinance the bond so that when that bond becomes due, that we actually are able to accommodate this. So now we're looking at solvency. So solvency, basically the same thing related to liquidity, but more of a long-term issue. We're looking at financial leverage, long-term debt, and other examples arise largely as a result of business, pensions, retirement, healthcare liabilities, and so forth. So long-term, and in fact, pensions is a very interesting issue when in fact, when we talk about long-term, we're talking about extremely long-term. Based upon whatever our calculations are in terms of our pension expense, we may or may not have a significant liability related to our pensions. But whatever the case is, this needs to be managed, and this needs to really be focused on a solvency, and the issue becomes is how we're actually addressing this in the years to come. And in our next session, we'll be talking about capital projects. One of the issues related to capital projects is how we're actually managing this from a long-term liability perspective. One of the things that's very interesting related to long-term debt is the fact that as we are considering the organization from an enterprise risk management perspective, it's critical that as part of our enterprise risk management is that we understand how debt actually is managed from this long-term perspective that we are considering. When we talk about leverage, the issue becomes is what we're doing is we are focusing on debt as opposed to equity. So let's just kind of talk about this from a sort of a broad perspective. So there's no question but that as we are planning future events, we need to consider these future events in terms of how we're going to pay these. So how we're going to pay these is either going to come from debt or from equity. Generally speaking, these long-term issues, these long-term projects are not going to come out of operating income. They're going to come out of either debt, issuing bonds, getting a mortgage, or issuing stock. So the issue becomes is if we use debt to pay for these long-term projects, is there are benefits to doing this. One of which is as we're looking at debt is we actually have interest. Interest is a tax-deductible item. Interest reduces amount of the tax liability, which is important because if we're paying and we're taking advantage of this, is we're actually using pre-tax dollars to pay for this debt. As opposed to if we're paying dividends, these dividends are paid on after-tax earnings. That typically lowers the cost of capital. As we acquire debt and we actually pay back our debt, we are actually considered to be in a very good position. One of the interesting things is many startup companies don't really have the option of acquiring debt. And the reason they don't have the option of acquiring debt is because no one will loan them money. But if people are actually willing to loan you money, that's a good thing. That essentially implies that you have the ability to tap into a market that some people actually don't. And as we are acquiring debt, what this does is, from a statistical perspective, is it actually lowers our cost of capital. That is typically less costly to issue. If we get a mortgage, cost is going to be very minimal in terms of acquiring this debt as compared to issuing stock, where there's going to be substantial fees upfront. Does not dilute ownership or earnings per share. Very important, because if you are an owner of the business, you're interested in maintaining your ownership percentage of the organization. By acquiring debt, this has no impact on your percentage ownership. If you issue stock to the percentage of the amount of stock that's actually issued, this is actually going to dilute your ownership within the organization. Banks offer additional levels of oversight. We talk about the fact that there is going to be various covenants related to our debt. So these covenants, bondholders actually take these very seriously. An organization is going to be very cognizant of the fact that they need to maintain certain cash, certain ratios to stay within the boundaries of these covenants. So the fact that they're there becomes very important, because you as an owner may not be aware of the intricacies of what's going on, but the bank is. And through their covenants, they're actually monitoring the organization at a much greater level than you would see in casual owners of stock. Management then needs to be more disciplined because of the cash flow requirements. Cash flow requirements become very important in debt, because you've got to pay your debt. If you have stock and you don't pay a dividend, well, stockholders are going to get mad, but you're not in any crisis situation. But you are in a crisis situation related to debt. You've got to pay your debt, and if you don't pay your debt, or you fall within the constraints of these covenants, it's going to really wreak havoc on the organization, because these banks and bondholders are going to essentially take your business. So very important to understand that if you have debt, you've got to pay your debt, and banks expect you to pay it. But if you do pay it and you stay within these covenants, it actually represents a very good thing to everybody. So if you're an owner of a business and the business is actually able to pay their debt, that's a very good thing. Again, I always try to emphasize the fact that debt can be a very treacherous road. But if you understand the value of acquiring debt and the value of managing debt, you in fact can be creating a tremendous amount of value to the organization. So don't be afraid of debt, but just make sure that when you have debt, you absolutely need to be far more disciplined in your approach related to cash. If you don't pay your bills, you are in financial distress. And if you've ever been in an organization, or you personally have been in financial distress, it's not a good thing. It's a very bad thing, and the business may not be able to survive if you don't pay your debt. You do pay your debt, everybody's happy. But if you don't pay it, creates financial distress. And again, the point that we want to make is that if we issue stock and we don't pay dividends, no big deal. If you have debt and you don't pay your debt back, or you're not paying interest, it is absolutely a big deal. So you do need to make these interest payments, no question. You've got to make these. You need to repay the amount borrowed, no question. You've got to do this. We've talked about these restrictive covenants. These restrictive covenants are going to come from bondholders and the banks that hold this debt. They are very interested in making sure that they address their risk before you get into this financial distress. So they're going to be following and monitoring you as an organization very closely so that you don't get into these areas that create problems. If you understand the value of debt and you manage it appropriately, that's a very good thing. I guess the scenario can be related to a credit card. Okay, so you got a credit card. So you've got a credit card that has a $10,000 credit limit on it. Okay, so I think I've got a couple of credit cards that have $50,000 in as a credit limit. Okay, so what does that mean? Does that mean that I am going to be an excessive risk taker and every month I'm going to spend $50,000? Well, of course not. The reason I have $50,000 in as a credit limit is because I actually am very risk adverse. If I'm risk adverse, people want to borrow money. And sort of the rule of the game related to banks is they want to lend money to people that are going to pay them back. So if you pay back, then you're in this scenario where you then create a good relationship and they want to lend you more money. If that creates an incentive for risk-taking, I guess that's a problem, but I would suggest that just the exact opposite is if you're actually paying your bills, you get encouraged to borrow more money. My guess is that you probably have the fortitude to say no or to actually consider each opportunity from an appropriate perspective. Okay, so again, encouraging risk-taking, I'm not necessarily sure I agree with this, but you need to understand that every organization is going to have their own risk tolerance related to debt. Total debt, very important, long-term debt, debt to assets, debt to equity, interest coverage, the times interest earned. All of these variables become very important as we're managing our long-term debt. The thing to keep in mind with all of these issues is as an individual number, it may or may not create any value. It creates value as we are comparing this number to prior periods or to industry standards. Control procedures related to liabilities, policies on when payments are made, we've talked about that. 30 days end of month, as an example, is very appropriate. We've talked about the payment cycle, and I believe we've talked extensively related to approving vendors, making sure that there's a process to approve vendors, making sure that the controls over liabilities are such that accounts payable is only approving for payment those items that have been purchased, so we have a purchase order, and those items that have been received, so we have a receiving documentation. So when the invoice comes in, we do what we call a three-way match, and we're matching the invoice to what was received and what was ordered, and then accounts payable approves for payment, but they're not actually making the payment. It then goes to cash disbursement, and then cash disbursement is going to have their policies related to when the item is actually paid. And this is where someone probably has made the decision is that we're going to manage this from the perspective of anything that's accumulated during March is not going to be paid until the end of April, as an example. And when we do this, we clearly are going to have a much better handle on our cash flow as compared to arbitrarily just paying things as they come in. And as we pay things as they come in, we may in fact create issues that are problematic in terms of cash flow. Managers who approve time should not have access to payroll. How about when they are due? Okay, so the question becomes, well, what if when they're due? Well, that's where we need to sort of manage the process. One of the things that you may want to consider is if the vendor has a scenario where that if you pay, you get a 2% discount if you pay within 10 days, certainly pay within 10 days. That's no question, that's a very, very good deal. Barring that, the issue becomes as well, when is it due? And this goes back to creating a relationship with the vendor. I've worked with a very large organization, and their policy, if you want to do business with us, you're going to get paid 60 days end of month. Period, end of discussion. And if their answer is, we want to get paid sooner, our response to that is, well, okay, you have a nice day, we'll find someone else. So in terms of when it's due, keep in mind that when it's due is going to be something that you negotiate. And if you negotiate this with the vendor up front, there's not going to be any issues. And that's really what we're talking about here, is management related to this this process. Managers who approve time cards should not have access to paychecks. Well, we're kind of moving from accounts payable to payroll. What we're talking about here is segregation of duties, so there should be specific segregation of duties in terms of all of our payments, in terms of approval and payment. Certainly, just like accounts payable. Accounts payable approves, but they're not paying. Their payment is coming from the cash disbursement. Same thing with managers. They are approving the time cards, but they are not holding on to these paychecks. It becomes very important because, in fact, I've actually been in scenarios where someone has created a fictitious employee and have attempted to get this person paid. Well, if you can get them paid and get access to their paycheck, well, that pretty much implies that you've essentially created a scenario where there is not the segregation of duties. Proper authorization for expenditures. We've talked, again, accounts payable is approving payments where we have the structure in place. Is purchasing is only going to make purchases based upon approved requisitions, based upon approved vendors and approved payment schemes or pricing schemes. These things are then received, and then when it's paid, or when accounts payable gets it, then the authorization essentially is embedded in the system as they're approving. When we look at long-term debt, is what we need to understand is understanding where our targeted capital structure should be. And when we think about capital structure, we're talking about the structure between the difference between equity and debt. So the question becomes is, what is our target? And those are the kinds of decisions that the board of directors needs to make in terms of where we expect to be in terms of managing our future growth, where cash is going to come from, how we're going to distribute our payments, distribute between long-term debt and equity. All these things become very important as we are managing the process. If in fact we have long-term debt, bonds or mortgages, we, meaning the controller, needs to understand what the metrics are related to these covenants and make sure that on an ongoing basis these are measured. The last thing that we want to do is come to the end of the year when the financial statements are released and the bank gets them and they say, well, you're not in compliance with the covenants, and we're caught by surprise. If we understand where we are during the year and we find that we are not managing these, we are sort of out of range within these covenants, it's very possible that we're going to be proactive, reaching out to the bank, explaining the situation, and developing a game plan in terms of approaching this. The last thing in the world you want to do is to ignore this and have a phone call from the bank or from the bondholder saying, we've got a problem. If you're proactive, chances are you're going to be able to find an answer to this, but without being proactive, you're not going to be able to manage. Cash budgeting, absolutely important. Everything that we've talked about implies that the cash that we get is not going to equal sales, because there's always going to be people that are not paying us, and we're always going to lag behind in terms of the cash that we're receiving. We understand that. But we also understand that we have to pay our bills. So the question becomes is, if there's a gap, We need to understand where that gap is going to be and how we're actually going to manage this. Variance analysis related to expenses. We want to make sure that the goods and services that we're buying in fact relate to our business operations. So when we start looking at variance analysis, we're going to see, hey, wait a minute, our cost of goods sold has actually increased on a percentage basis as compared to last year. So are we buying more things? If we're buying more things, why are we doing this? What are the things that we can do in terms of managing this? Everything becomes critical. And the last piece related to this is bank reconciliations. Going back to cash, is we absolutely need to be doing bank reconciliations every month, and we need to be doing these immediately after we get the bank statements and not waiting to the end of the year and trying to reconcile 10 or 11 months of data. Bank reconciliations need to be done immediately, and bank reconciliations are going to help us understand what's actually taking place, specifically related to any issues that might arise in terms of errors or mistakes or things that we missed or whatever. So let's talk about equity. Equity is essentially the wealth of the organization. We need to understand how we're managing equity. Managing equity, again, we're looking at contributed capital, we're looking at retained earnings, and to the extent possible is we need to understand what our role is related to this. And our role related to this is going to come from a determination of some very specific decisions coming from management. May not be coming from the controller, but once those decisions have been made in terms of how we're going to manage our long-term projects, we then need to decide what we're going to do. So let's focus on a couple things. Equity is the wealth of the company. It's what we call the residue interest of the firm, and we have the invested capital, contributed capital. Earned capital is retained earnings. Keep in mind that retained earnings is our net income minus any dividends that have been paid from the inception of the business. So if we have a retained earnings, it means that overall we've actually generated value in terms of earnings for the organization. If we have a deficit, basically means that the organization overall has actually not made any money based upon their activities. When we think about the cushion, what we need to understand is that just because retained earnings is there doesn't mean that we need to pay this as a dividend. We need to sustain cash. This is to protect our senior debt holders and also to actually sustain the organization specifically related to any bond covenants. Income and share issuance increase equity. What are we talking about this? Again, back to the income increases equity through retained earnings. We issue additional shares. This is going to be a part of our contributed capital. If we have losses, pay dividends. If we buy back stock, as in treasury stock, all these things are going to reduce. We need to account for equity using GAAP, perform analysis concerning funding, timing, amounts, and sources. If we're a large organization, we're probably not managing our shareholder records. If we're a small firm, we probably are. Analysis of various equity matters, dividends, stock buybacks, earnings per share. These are the kinds of things that we need to manage. Okay, so we're funding growth. Funding growth, we can do equity, we can do debt, or we can do retained earnings. This is really the only way that we can manage the growth of the organization. The issue becomes with the retained earnings. What are we going to do related to retained earnings? In the decision, sort of the theoretical decision that we need to make, is it more valuable to have these earnings distributed as dividends to the owners, or is it more valuable for the growth of the organization to retain these earnings and use this to fund growth for the organization? That's the question that organizations need to consider. Usually, startup organizations are not going to pay dividends because they want to retain their earnings. But as a company matures, this is when they're going to start paying dividends. those are general thoughts related to our dividend structure, but keep in mind that every instance is going to be different. Internal growth is return on equity times the retention ratio, also the calculation for growth in earnings per share. Actions that increase earnings per share, increasing retained earnings, increasing retained return on equity, repurchasing shares as long as return on equity does not decrease. So there's kind of a window of opportunity in terms of if we purchase treasury stock, that basically means that our outstanding shares is going to decrease. So the outstanding shares essentially becomes the denominator in the calculation for earnings per share. So if we can decrease the denominator, then we can actually increase our earnings per share. As long as the return on equity does not decrease, we're looking at positive financial leverage. Acquisitions, if the targeted PE is less than the acquiring PE. So we can actually increase our earnings per share by considering purchasing another company. Weighted average cost of capital, how much does it cost to raise capital? An investment needs to earn at least this rate, otherwise it destroys value. So what we're saying here is that when we're considering an investment, we need to consider investment from the perspective of alternatives and where that is coming from. So the issue becomes is that if our weighted average cost of capital is 5%, but we're going to use this money on a project that's only generating 4%, we've essentially destroyed value. So the weighted average cost of capital becomes very critical as an organization considers how they're going to invest for the future. We also might want to use the discount rate used in a net present value analysis. Consists of the cost of debt, preferred equity, and the common equity. Cost of debt is, we consider the after-tax, generally the cheapest component. We need to take issuance costs and every other premium into consideration. So when we're thinking about debt, it certainly applies to equity also, what we are considering is the fact that there is a cost in acquiring this debt. There's issuance costs related to the debt, related to a bond, also related to equity. We need to understand how much this cost is, and this is going to play into our calculation of what our cost is. We also need to understand that, as we've talked about, there is the after-tax effect cost of debt. If we're paying 5% interest, we're really not paying 5% interest because there is a tax effect that this interest is tax deductible. So we're actually reducing our tax liability to the IRS. So to the extent that what our tax rate is, that is going to impact our cost of debt. The calculator is the interest expense times 1 minus the tax rate. So if the tax rate is 40%, the interest expense times 60% is essentially the amount that is actually affecting. So the denominator is the proceeds from the issuance. If no fee or discount, it's the interest rate times 1 minus tax rate. Okay, preferred equity is the cost of the preferred stock, the issuance cost. It is not tax deductible. Although preferred stock dividends are expecting to get paid before any common stock dividends, dividends are usually represented as a percentage of par, a little bit different than common stock, and may also have to take issuance costs into consideration because anytime we issue stock, there is a cost. Everybody have a great evening, and we'll talk to you then. Okay, thanks a lot. Okay, I appreciate it.